Let's say you run a bookstore. A customer walks up, hands you a $20 bill, and walks out with a novel. It happens dozens of times a day. But how do you keep track of all that money coming and going without losing your way? For centuries, businesses have used a basic rule of financial physics called double-entry bookkeeping. The core idea is that value never just appears or vanishes, it only moves. Because value is always on the move, every single transaction has to answer two distinct questions. Where did the value come from, and where did it go? This scale shows how that looks on paper. When you sell that novel, cash goes up by $20. Simultaneously, your book inventory goes down by $20. You record both ends of the move, and they must always stay equal to keep your system in balance. This simple requirement that both sides must always match is the logic that keeps a company's records organized, no matter how many thousands of books it sells. To see the total health of the business, you go to the general ledger. This is the master record that holds the running balance of every single account in the shop. To keep that master record organized, companies use a chart of accounts. Think of it like a digital table of contents that assigns a specific code and category to everything the store owns or spends. For instance, the unsold novels on your shelves are categorized as inventory. They are physical assets that stay on your books until the moment you sell them. Then there are the long-term items you use every day, like the heavy wooden bookshelves and the cash register. These are your fixed assets. Since a bookshelf might last for a decade, you don't count the entire cost on the day you buy it. Instead, you use depreciation to spread that cost out evenly over the many years you'll actually use it. These systems translate the physical reality of your bookstore into a standardized language, ensuring no asset or expense goes uncounted. Sometimes, however, the value moves before the cash does. If a regular customer takes a book today but promises to pay next week, you've earned that value. You just haven't received it yet. You record that as a receivable. It's a promise of payment that counts as an asset. It works the other way, too. When a publisher sends you a crate of new bestsellers but gives you 30 days to send the check, you have a payable. It's an obligation you are on the hook to pay later. This creates a mystery. Your general ledger might show a total of $5,000 in receivables, but it doesn't list the individual names of the people who owe you. To find those names, you look at the subledger. As you can see here, while the main ledger holds the summary, the subledger holds the granular details, the individual invoices and receipts that make up the total. The main ledger shows you the big picture of your store's health, while the subledger gives you the specific data you need to collect money and pay your vendors on time. Now, suppose your business grows and you open a second bookstore location across town. To help the new store get started, your original shop lends the sister store $100 to buy some supplies. This is an intercompany trade, a movement of value between two shops that belong to the same family. Because both stores share the same ultimate owner, this $100 debt nets to zero at the group level. The $100 leaving one pocket is simply entering another pocket in the same pair of pants. Identifying these moves is crucial. If the internal debt isn't canceled out, the company would be counting its own money twice, making it look twice as wealthy as it actually is. At the end of every month, after weeks of selling books and tracking debts, the finance team has to prove that all these records are accurate. They perform a month-end close, where they briefly freeze the books so no new transactions can change the numbers while they are being checked. The most important step here is reconciliation. The team compares the high-level totals in the main ledger against the detailed subledgers and external bank statements to ensure they match exactly. If there's a mismatch, they hunt for typos or missing receipts until the scale balances. This ensures errors are caught early, rather than piling up. Once the records are verified, the books are hard closed. This lock prevents anyone from going back to alter a transaction, creating a finalized, unchangeable record that can be presented to owners or outside auditors. Whether you are running a local shop or a global group, these rules provide the proof. It is a system designed to show exactly where your value came from and exactly where it went.